All right, so let's go on to the rest of chapter 6 here. We've already talked about the dividend discount model, or the Gordon growth model, and that's where we ended last class period. So now we're going to jump into the residual income model, which is quite similar in many regards. The key difference here between residual income and dividend discount model is that you don't need a dividend to use the residual income model. You can still use the residual income model with a company that pays a dividend, but it's most valuable to us because you don't have to have a company that pays a dividend. So this idea of residual income, there's a relation in accounting called the clean surplus relationship, and basically it's the change in book value per share is equal to the earnings per share minus the dividend. So we're going to start from that basis. You can think of that as more or less a tautology, I think. So stockholders have some sort of required rate of return, and we call that K. That's the same K that we calculated when we were doing the dividend discount model. And that required rate of return, the required rate of return the required earnings per share is the book equity at the beginning of the period times the required rate of return. And so the difference between that value and the actual earnings, that is the residual. It's what's left over. If it's positive, then we have done better than what we needed to do. And this concept is known in economics as the economic value added. Quite honestly, I think it's easier to see when we're looking at the formula right here. And my preference is to use this formula here. The one below, down here, same exact formula, just a slight algebraic change in the notation, the way it's set up. What I like about the first formula, though, is when we look at this thing right here, this part of it right there, B sub 0 times K. Well, let's go up here and look at what B sub 0 is: book value per share at time 0. So that's that book value of equity at the beginning of the period. And of course, K is our discount rate. And that's also known as the required rate of return. So what we're taking is the book value of equity on the balance sheet times the required rate of return. That's what we should be getting. That's how much we should be getting in terms of earnings in the next period. Okay? So that's that required return, or expected return is another way you could define that. And then this piece of it, this term in the numerator right here, that is the actual earnings. And it says EPS 0, that's last year's earnings, but we're going to grow that at the growth rate of earnings. So EPS 0 times 1 plus G is equal to next year's earnings. So that's the actual earnings that we get. So the actual earnings minus the earnings that we should be getting given the riskiness of the company and the book value of equity. If that value is positive, then we have created economic value in the company. Now, one question that one could easily ask about that was, wait a minute, I thought there were no free lunches. This looks like a free lunch to me. And the answer is, yeah, it is a free lunch. In fact, firms, another odd thing here, you've all heard of NPV, right? Net present value. And you've all heard the rule is you take only positive NPV projects. Well, when you're calculating an NPV, you're discounting by some value, which represents the riskiness of that project, right? That's the K. And if you get something greater than the cost of that thing, you're actually also getting a free lunch. Why are there such things? Why are there free lunches out there in the corporate world? And I think the short answer to it is that, hey, not everybody has looked at everything, and markets aren't totally efficient. So these companies are going out there looking at projects. And hey, if they see a project that's going to give them back more than they should get, they're going to take it, just like you and I as investors, right? If we can find a stock that's undervalued and we can buy it, and when we should be getting 12%, we end up getting 14%, we're going to buy those all day long. Same is true of the company. So you can think about this numerator, if it turns out to be positive, is that that company has taken on a number of positive NPV projects. Now, the assumption embedded in this equation that you're looking at right now is that they're able to find these projects on a regular basis every year from here to eternity. Now, is that realistic? That's another question. But again, these are back of the envelope, coming up with a relatively simple valuation without putting in a whole lot of effort. You just have to calculate a K and a G, and the rest you can get off of the balance sheet and the income statement, plug and chug. Boom, there's a number. So let me also notice how this fraction right here, if you'll remember the DDM, the dividend discount model, the constant perpetual growth version of the dividend discount model, said that price was equal to the dividend that just was paid times 1 plus the growth rate, which will equate to the dividend that's next in line to be paid. And then we're going to divide that by K minus G. That is a closed form solution to an infinite series, an infinite sum. So we're summing from time 1 out to infinity, assuming constant growth. Well, look at this formula. Same sort of setup, right? We've got that K minus G in the denominator, and we've got some value in the numerator. That's perpetual growth, constant perpetual growth. Now, we're going to add, what's different about that than what we have over here in the DDM is we're going to add to that the book value of equity that we currently have in the firm. So not only is it what we're going to get in the future, but it's what we already have invested in the firm. So the sum of those two is the price that the stock should be selling for. And like I said, this second equation is exactly the same. I just don't think it's quite as intuitive when you look at the numbers here. I think this first formulation is extremely intuitive. That's why I like to talk that one through and kind of disentangle all of the stuff out of this formula for you that way. Questions about that? Because this is, if that's not clear, then the rest of this won't make a whole lot of sense either. All right. Here's a brief example. I'm going to walk through this. So we've got Quackenbush, also known as DUCK. They have shares selling in the market at $10.94. We're going to use the residual income model. I apologize. I've got something in my eye here. So we're going to use the residual income model to value those shares and see what we come up with for a value. So we've got the current earnings of $1.20. This is a company that doesn't pay a dividend. And we have a book value of equity of $5.886 per share. And we have a growth rate of 9% and a required rate of return, or a K, of 13%. So we can plug in our EPS, our growth rate, our book value of equity, required rate of return, likewise down in the denominator, and there's our growth rate. Here's the book value of equity again, and plug and chug, and out pops a number like this, $19.46. So one thing we could say is, boy, this stock is severely undervalued. I want to buy that sucker, and I want to buy a lot of it, because when it goes up to $19.46, I'm going to make a whole lot of money. I'm going to make $8.52, right, on every single share. It's a heck of a return. Yeah, but we've got a couple of things here that we estimated, right? We've got a K. We could be wrong on the K. We've also got a G that we could be way off on. In fact, a G of 9%, assuming we carry that 9% out to infinity, that's a heck of an assumption, folks. I'm telling you. The economy grows on average around 3 to 4%. If I have a company growing at 9% forever, it's going to outstrip the size of the economy at some point. So that's a ridiculous assumption. So let's rethink our growth rate. In fact, let's kind of reverse things here and let's plug in on the left-hand side a P sub 0. Let's use the market value, that $10.94, and let's see back out of this what an implied growth rate is. Now, this is something that investors and analysts often do as well. Just as kind of a way of checking yourself and making sure that you're not coming up with some crazy assumption. So if we do that, we plug in $10.94 as the value of the stock, everything else stays the same, and then we solve for G, we end up finding that, a G of 3.5% is implied by the current market valuation on the stock. Boy, that's a heck of a lot more reasonable too, especially since I'm assuming this thing goes out to forever. And we could actually do a residual income model with a two-stage setup, just like we did with the dividend discount model, where we actually have a supernormal growth rate for T periods, and then we revert back down to some lower, more sustainable growth rate from T periods on out to infinity. That's another alternative. I've actually posted that on the modules section of the of Canvas, a version of a residual income model that has two stages, two growth rates in it. That's one possibility, but certainly you want to check yourself on this. And when you're analyzing Sherwin-Williams, do the same thing. You may come up with some really high growth rates, but are those sustainable for forever? So when you plug into a formula that assumes we're taking this out to infinity, we often get some pretty crazy answers. All right, questions on residual income model, because we're about to shift over to the last model in this section of the chapter about intrinsic valuation or fundamental valuation. But before I do that, let me stop and see how everybody's feeling about the residual income model. Feeling okay? All right. So then let's move on to free cash flow to the firm. And I've added, I think if I remember correctly, the book simply calls this free cash flow. They make the assumption that we know it's to the firm. And the answer to that is no, we don't. Because there's free cash flow to the firm and there's also free cash flow to equity. Very different animals. And what the textbook is talking about is the former. We are actually in our security analysis going to use the latter measure. They're both really good measures. Free cash flow is kind of if you want to think about a type of cash flow or earning stream that a company generates, you really want to use free cash flow. That's the real number. Those of you, how many of you are? I think there are a couple of you that are double majors. Anybody in accounting? Yeah, Matthew. And you join? You're in. And Benjamin. Okay. You all know better than any of us that earnings can be manipulated. There's a lot of flexibility in how you depreciate something. There's flexibility in how you account for the use of inventory to generate a cost of goods sold, things of that nature that are going to cause earnings to vary from one firm to another depending upon the accounting convention that they choose. Now, as financial analysts, we want to try to minimize that sort of thing. So financial analysts have come up with this concept called free cash flow, wherein we talk more about how much actual cash are we talking about, as opposed to this more fictional idea that we call net income or earnings. And so that's where finance will deviate considerably from accounting. Now, I'm not saying that the accounting profession is doing anything wrong. They're trying to allow the earnings to represent something over a long period of time, and there's justification for doing it that way. But the finance side of the table also has justification for using this free cash flow, so that we can compare one firm to another more easily. So anyway, this particular version of intrinsic valuation uses free cash flow to the firm. All right. Now, another of the advantages, I should say, is right down here. We can have a company that has negative earnings, but has a positive free cash flow. And that's why that company has value. Let's see how that is possible. But before we do that, let's talk a little bit about how do we actually calculate this thing. So we're going to start off with EBIT, and we're going to multiply it by 1 minus the tax rate right here. And that's going to give us an after-tax EBIT, earnings before interest and taxes. Then we're going to add back the non-cash deductions that we take out of the income statement. And the key one here is depreciation. That's a non-cash deduction. We're adding it back. And then we're going to subtract out a couple of cash flows that don't ordinarily show up on the income statement, at least directly, because they're really embedded in that depreciation figure. But we're going to subtract out any capital spending, and we're going to subtract out any changes in net working capital. Can anybody tell me what's net working capital? Do you remember? I see Marcus is Googling it, which is a good idea. Right? Maybe not. What is net working capital? Matthew, go ahead.
Is that like the same as working capital, which is like current assets less current liabilities?
Yeah, right. Exactly. So we're really looking at, and the net part of it is because we don't use all of those accounts in current assets necessarily, or in current, let's see. Yeah, and in current liabilities. But we can get to that later. But the idea here is that we need that net working capital if we're investing in a new project, right? We're going to have some inventory. We're going to have some additional cash needs. We're going to also have accounts payable. We're going to have some accounts receivable. So that's an expense, and that's a real cash flow. So it's easy to see how if, say, for instance, let's say this EBIT, even after tax, is negative, if we have a very large depreciation deduction, that can turn this value, this free cash flow, to a positive value. So as to kind of further prove this example, or further prove this concept, here's an example. We've got Twiddledee and Tweedledum. We have revenues of $5,000 in each. We have cash expenses of $3,000 in each. And we have a cash flow of $2,000. However, each company deals with its depreciation in a slightly different fashion. So Tweedledee uses straight line. Tweedledum uses accelerated. So in the first year, they, instead of deducting $1,000, they deduct $1,500 in depreciation. So what that's going to do is that's going to decrease their net income, which decreases the tax burden early on, which makes sense because decreasing even if the tax burden ends up being the same, if I don't have to pay it until further out into the future, the present value of my tax burden is decreased, right? So you might be saying, well, what's the point of all of this? Well, it is because I want to decrease the present value of my tax burden. That's why I'm using accelerated. But when we look at these two companies, the net income differences here, so we see net income as $1,000 And then here we see it as only 500, 1,000, and then 1,500. Those variations don't show up when we're simply looking at cash flow, because those two companies really truly are the same. They have the same cash flows. It's only the difference in depreciation that matters here. DDM versus free cash flow to the firm. Obviously, the dividend discount model uses dividends. It does use CAPM as the required rate of return, and so does the free cash flow model. And here's another key difference, and again, this relates to that last letter that the book left out to the firm. DDM uses an equity beta, and in the free cash flow to the firm, we're going to use what's called an asset beta. The reason we need to use an asset beta is that we're looking at free cash flow to the entire firm, not just the equity portion of it. We're looking at both equity and debt. And so rather than looking at the riskiness of the equity piece, we need to look at the riskiness of the asset piece. Now, since we don't get to see the returns directly on the assets, we don't know what the market is for that. It's very difficult to calculate it directly. So there's a way to calculate that, though. If we know the equity beta, we can back into the asset beta. And here's the formula to do this. And again, I don't know why your authors showed it this way, because actually what we're trying to calculate here is the asset beta. We know what the equity beta is, or we can calculate it. We know what the amount of debt is and the amount of equity, and we know the tax rate, and we plug those things in. And you'll notice here, using this version of the formula, that the asset beta times this thing and this value in the brackets, if debt is 0, that cancels this whole thing out, and this just becomes 1. So when there is no debt, the asset beta equals the equity beta. When there is debt, the value inside the brackets is greater than 1, meaning that the equity beta is going to be higher than the asset beta, which makes sense, right? Because equity is a riskier position when we have debt on the balance sheet. But it's a relatively simple formula, just plug and chug to get your asset beta. And of course, instead of what they're showing, you're actually going to be computing the asset beta as the equity beta divided by the value in the brackets. And I'm just going to use a dot to represent this whole mess right here. All right, so that's the formula you'd use to get your asset beta. And you would use that asset beta to calculate your K. As far as the inputs, we just need to calculate that free cash flow, which from the income statement, we need the net income and depreciation, and then we need CapEx and the net working capital changes from the balance sheet. We need to figure out how quickly cash flow is going to grow. Now, when you look at cash flows and earnings and dividends, those growth rates are going to vary even within the same firm. In many of our problems, and even in the security analysis, we're going to assume that they're very close, in fact, so close to one another, we're actually going to use the same growth rate. But in reality, at least in the short run, these things can vary from one another. We also need the K. We need a tax rate. We need to know what level of leverage there is. And then we need to have an equity beta. And we plug and chug, as they say. It's kind of a modified DDM, if you want to think of it that way. All right, so that's the end of talking about free cash flows and the end of talking about what I call intrinsic or fundamental valuation techniques. The rest of the chapter gets into relative valuation techniques. Relative in the sense that we can't price this in isolation, but we can price it if we know the prices of some other things. This is what economists call a partial equilibrium. A full equilibrium model allows us to price something without knowing the prices of other things. A partial equilibrium model says, well, if we know the prices of some things and we think that they're correct, then we can price this other thing on that basis. And that's really what these relative measures do. That's not only the strength, but also the weakness of these relative measures, because we're making an assumption that the things that we're using as comparables are correctly priced. We're also assuming that the market is correctly priced. Now, that's a strength and a weakness, right, really, because the weakness of it is that many of us don't believe that the market's always correctly priced. Those of us that live in in one world, I'll call it the saltwater economists, we believe that there can be mispricings in the market, and they can be systemic, and they can last for longer-ish periods of time. The freshwater economists believe that there is no such thing as mispricing, that markets are always efficient. So those economists would really seem that relative valuations are problematic for those sorts of folks, because why would I need to do that? Whatever the market says the price is what it actually is. But I won't go down too much further down that road. But there is quite a heated debate, shall we say, over those sorts of issues. Let me jump here, though, I'm going to jump to Aswath Damodaran's video here. We're going to spend about, let's see, it's 7:05. This is going to run about 15 minutes. But since he is the Dean of Valuation, he does a great job of explaining the relative valuation methods. And so I'm going to get that started up here. I think I've got it queued up, actually. I'm going to need my earphones, though, so that I can hear the video along with you all. All right. Here we go.
So let's say you decide to buy a house. You hire
And you all heard that audio, right? Cool.
a realtor. The realtor shows you the house, and then he or she gives you a number, $500,000. How do you think she came up with that number? She didn't do an intrinsic valuation of that house. She basically came up with that number looking at other houses in the neighborhood that had sold in the recent past. That is the essence of relative valuation. In relative valuation, you value an asset based on how similar assets are priced. In contrast, in intrinsic valuation, you valued an asset based on its cash flows, growth, and risk. The two are obviously interconnected, but they're not always going to give you the same answers. Most analysts who do valuation do relative valuation, and many of them do it badly. In this session, I hope to take you through a 4-step process to make sure, if you use relative valuation, that in fact, you're dotting your I's and crossing your T's. So we've talked a lot about intrinsic valuation, right? And I don't blame you for thinking about intrinsic valuation as the only way to value a business. I like intrinsic valuation, but in this session, I want to introduce you to the technique that most people use to value businesses, which is relative valuation. What is relative valuation? Well, here are the basics. In relative valuation, you value an asset based not on its cash flows, growth, and risk, but based on what similar assets are priced out there. If you use StubHub to buy a ticket or eBay to buy something, you're doing relative valuation. You don't try to value the asset, you look to see what other people are paying for something to decide what it's worth. In the context of valuing assets, here are the 3 pieces you will see in a relative valuation. First, you'll see a standardized price. What do I mean by that? Let's say you're buying a house. A 5-bedroom house will cost you a lot more than a 2-bedroom house. So rather than compare the prices of houses, we look at price per square foot. So first you have a measure of standardized price. Second, you have a set of assets that you call comparable. You're saying these are similar assets that have traded, and these are the prices they traded at. And I would put quotes around the word similar. because there are probably differences. Even if you're very careful about your choices, you're probably still going to see differences. And the third step is, if you're careful, you'll control for those differences. So there's a standardized price, there are comparable assets, and there are some ways of controlling for differences across assets. That is the essence of relative valuation. If you ever read an equity research report, you know what I've just described, right? The standardized price usually takes the form of a multiple. The similar assets are usually called comparable firms, and the controls are usually storytelling. But that's relative valuation. Now, before I delve into relative valuation, I should also tell you that relative valuation is pervasive. It's all around us. In fact, to show you how pervasive it is, I'll give you a couple of statistics. About a decade ago, I collected about 550 equity research reports from around the globe, different investment banks, different equity research houses. I must confess, I didn't read most of them. I collected them because I wanted to categorize how equity research analysts approach valuation. Out of the 550 equity research reports, about 45 were discounted cash flow valuations, less than 10%. About 450 were relative valuations, a multiple and comparables. The remaining 55 were kind of fuzzy. I couldn't quite categorize them. But among the ones I could categorize, 10 to 1, relative valuations outnumbered discounted cash flow valuations. I took a look at about 100 acquisition valuations, hoping or expecting things to be different in corporate finance. Out of the 100 acquisition valuations, I got a much more even split. About half were discounted cash flow valuations, half were relative valuations. But then I took a closer look at the half that were discounted cash flow valuations, and I noticed that in most of them, the biggest number, the terminal value, was estimated using a multiple. So even those were really relative valuations. Almost every rule of thumb you see out there is based on a multiple, right? What am I talking about? Price to book less than 1 is cheap. A price earnings less than 10 is cheap. They're all based on multiples. What I'm trying to say is the language of valuation around us is a language of relative valuation. So when I first ran this statistic, I was a little puzzled by my finding, and here's why. When I teach my valuation class at NYU, I always end every class with a question. And this is after everybody's valued their companies using multiple approaches, discounted cash flow valuation, relative valuation, whatever other approaches they might use. So I asked them at the end of the class, after they've tried these approaches, if they had to pick an approach, which one they would pick as their preferred valuation approach. In the 25 years I've taught the class, I get pretty much the same answer. About 70% pick discounted cash flow valuation or intrinsic valuation, reflecting, I guess, my biases. About 20% pick relative valuation, and about 10% are not quite sure. So 7 to 2, when people leave my room, they say they're going to use discounted cash flow valuation. I haven't done a follow-up questionnaire, but if I did a follow-up question 5 years later and asked these people on their jobs, I don't know what jobs they're at, what approach do you use to value companies? I'll wager the numbers get switched. That 70% use relative valuation and maybe 20%, maybe, still use intrinsic valuation. So I started thinking about what it is about relative valuation that makes it so attractive to analysts. And I've come up with 3 possible answers, and feel free to add to this list. The first one came to me while I was watching a Seinfeld episode. One of those episodes where one of Jerry's many girlfriends accuses him of being crazy. He says, "Jerry, you're crazy." He says, "If you think I'm crazy, you should see the guy who lives across the hall from me." And if you've ever seen a Seinfeld episode, you know who lives across the hall from Jerry, right? It's Kramer. And relative Kramer, who's crazy? You're saying, what's this got to do with relative valuation? We forget how much of valuation is selling, right? So if you're trying to sell me something.
To how many of you is that a really oddball reference? Anybody watch Seinfeld still? Have you? Oh, okay. You've seen? Okay. Kramer is nuts, right?
It's far easier to sell me something with a relative valuation than an intrinsic valuation, because here's all you need to do. You need to find something even more overvalued than what you're selling me. You say, look, it's cheap. It's cheap relative to these 5 other things I found out there. Relative valuations are far easier to sell than intrinsic valuations, because as long as you let me pick the multiple and you let me pick the comparables, I can tell you whatever story I want to tell you. Second, it's far easier to defend a relative valuation than an intrinsic valuation. And here's why. In intrinsic valuation, your assumptions are all explicit. Everybody can see what you're assuming about cash flows and growth and risk, and that's dangerous because they can pick it apart. In relative valuation, all your assumptions are implicit. So when you use 12 times EBITDA, you are making assumptions, but nobody can see what those assumptions are. And if they cannot see them, how can they pick them apart? And third, and this is something that we don't factor in enough when we think about valuation. I personally think in the long term, you're far more likely to be right with intrinsic valuation than relative valuation. But here's the catch. When you're wrong with intrinsic valuation, you're also far more likely to be wrong alone. You're saying, so what? If you're wrong alone, you tend to be fired. If you use relative valuation and you're wrong, you're always going to have lots of company. And that's a safe place to be. The survival instinct kicks in. And that's why I think more people use multiples than intrinsic valuation. Even if you're a true believer in intrinsic valuation, here's my advice to you. Understand relative valuation. Keep it in your arsenal. It doesn't have to be an either or. I am a true believer in intrinsic valuation, but I still do relative valuation. I'll often frame my intrinsic valuation in terms of relative value. So don't give up on relative valuation. So let's talk a little bit about how we can bring relative valuation into our toolkits. Before I talk about the 4 basic propositions or ways in which you can prevent yourself from making mistakes with relative valuation, let me first go back and talk a little bit about multiples. As I said, to make comparisons across companies, you got to use a multiple. And
Now, please pay close attention to this part of it because he's going to be talking about the variety of multiples that you guys will all be using and whether they're consistent or inconsistent. By inconsistent, he means that the numerator and the denominator don't agree with one another. In other words, if we're talking about the price of equity and we've got in the denominator something that is a cash flow that goes both to equity and debt, that's an inconsistent ratio. But we want the numerator to have the same parties, if you will, as the denominator. So, for instance, he'll tell you that PE is a consistent ratio. That's because the price in the numerator is the price of a stock, and the E in the denominator is earnings per share of the stock. Both relate to the stock. So, and then he'll also talk about these 4 factors. I'm going to stop at the end of the second one, but please pick up on this video later on, especially as you're working on the security analysis.
Multiple is a numerator and a denominator. And here's the way to think about it. In your numerator, you almost always need a measure of market value. That market value can be just of your equity, that's market cap, as is the case with price-earnings ratios. It can be market value of equity plus the value of debt, which is the market value of the firm. It can be market value of equity plus debt minus cash. That's called enterprise value. So in almost every multiple, you're going to see one of those 3 numbers: market cap, value of the firm, or enterprise value. The difference between enterprise value and firm value is enterprise value is net of cash. So it's firm value minus cash. In the denominator, you can see one of 4 measures. You can see revenues because you're wary about accountants and what they can do to the bottom line numbers. You might see earnings per share, operating income. You might see even measures of cash earnings, EBITDA. You might see book value of equity or book value of the entire firm, or you might see some sector-specific measure. What am I talking about? Remember the late 1990s when .com companies were compared based on value per website visitor? You can compare steel companies by dividing the market value by the number of tons of steel they produce. But basically, it could be some measure of operations, market value per employee, market value per unit output. But in all of these measures, what you're trying to do is you're trying to scale market value to some common variable. That's the first step in relative valuation, is to get a sense of what those multiples are. Because I'm going to take you through a 4-step process that if you're religious about following, you're going to be okay with relative valuation. Because my problem with relative valuation is not that people use it, but that they're shoddy about the way they use it. And here are the 4 steps I'm going to go through. I'm going to start off by defining the multiple. I don't mean to be insulting. You're probably saying, I know what the PE ratio is. I know you do. But your definition of PE and my definition of PE might be very different. I'm going to describe the multiple. Sounds fancy, right? But I'm going to use Stat 101. I'm going to put up a histogram. I'm going to count the number of companies with P/E ratios between 0 and 4, 4 to 8, 8 to 12, put it on a distribution. Because the distribution is going to tell you some very interesting statistical things about multiples. Then I'm going to analyze the multiple. I'm going to argue that embedded in every multiple are all of the assumptions you made in discounted cash flow valuation about cash flows, growth, and risk. I'm going to make your implicit assumptions into explicit assumptions. And only then am I going to apply the multiple. Define, describe, analyze, apply. In too many cases, you see analysts trying to apply a multiple without going through the first 3 steps, and that's what gets you into trouble. Let's start with defining the multiple. When I look at a multiple, there are 2 basic questions I ask. The first question I ask is this multiple consistently defined? Let me explain. As I said, every multiple has a numerator and a denominator. If your numerator is an equity value, your denominator has to be an equity value as well. If your numerator is a firm or an enterprise value, your denominator has to be a firm or an enterprise value as well. You have no idea what I'm talking about, right? Let me back up. Let's take P/E ratios. Think of what's in the numerator. It's a market value of equity, right? And in the denominator of earnings per share, which is equity earnings divided by the number of shares, which is okay. Thank God for small blessings. The most widely used multiple in the world is consistent. Or EV to EBITDA. In the numerator, you have market value of equity plus debt minus cash, a rough measure of the market value of the operating assets in the company. And in the denominator, you have earnings before interest, taxes, depreciation, and amortization, a rough measure of operating cash flows. EV to EBITDA is okay. So here's what's not consistent, a price to EBITDA ratio. And here's why it's not consistent. Your price is a market value of equity. EBITDA is an operating cash flow. You say, what's wrong if I use it and I'm consistent? I use it for all 15, 20 companies in my sector. It's still not going to work. And here's why. If you have companies that borrow a lot of money, let's say they borrow money to buy back stock, their market value of equity will drop, right? But their EBITDA will not be affected by the borrowing. Those companies are going to look cheap to you. If you mismatch your numerator and your denominator, use equity value in the numerator and use a pre-debt value in the denominator, you're going to find companies that borrow a lot of money look cheap to you for all the wrong reasons. So check your multiple to make sure it's internally consistent. Second, make sure it's estimated exactly the same way for all 15 companies in your sector. It's actually a tougher test to meet than it sounds. If using price-earnings ratios, here's what I'm asking you. Is earnings per share estimated exactly the same way for all 15 companies? That doesn't just require that you have the same accounting standards, right? You need all companies to have the same amount of fidelity to those accounting standards. If they don't, aggressive companies are going to look cheap to you. So watch out. Second step in the process, describe the multiple. As I said, this is basic statistics. When you have a lot of data, put it up in a distribution. Because what you're going to get a sense of when you put up this distribution is what's high, what's low, what's typical. One of the things you're going to see when you put up the histogram, and you're going to see a few in the next few sessions of each of these multiples, is none of them is symmetric. Why? Because a multiple can never be lower than 0. A price-earnings ratio cannot be less than 0. But it can be 15,000, 20,000, 25,000. You're saying, so what? When you have a distribution where the lowest value is 0 and the highest number could be any number, your averages are going to get pulled out by those outliers. I remember what my stat professor said in my first statistics class. He said, if you have an asymmetric distribution, a distribution where the outliers are all on one side, he said, trust the median, not the average. So we'll look at the statistics of these distributions, but it's good to look at the data. 25 or 30 years ago, you could have had the excuse of saying it's too much work. That's no longer true. Today, we have the data to look at, and there is really no basis for rules of thumb if you don't have the data to back up those rules of thumb. So that's the second step. Look at the distribution, make sure that the distribution meets your characteristics.
So I'm going to stop it there. I'll leave it to the rest of you to watch the last 3 minutes in this analytical test and then applying the ratios. You're going to be doing this, so I really strongly recommend this video in particular. But he's got a couple dozen of these out there on valuation. It's just a treasure trove of information that he has given to us. All right, let me get these off. It's difficult to speak with myself in my own ears. All right. What do you all think of his description? Any comments? Observations? Come on. You guys are going to be financial analysts. Hopefully this is exciting at this point. If it isn't, I can't imagine what it's going to be like for you 2 or 3 years into the job. You know, this is fun stuff. The way he describes it is the way that it should be done. I'm afraid and I'm concerned, and he has the same concerns, I think, that oftentimes that's not the way it's done by folks on Wall Street. So hopefully, over at least a period of time, eventually we'll get enough students out there in Wall Street that are more careful about the way they implement these relative valuations. Too often it's a matter of finding a few comparables and then throwing that and multiplying that by the EPS, and off you go. And that's definitely fraught with problems. Let's see. As far as PE ratios, what the only thing off of this slide that I really want to point out to you is anybody who isn't already familiar with high PE versus low PE stocks. By the way, as Aswath mentioned, this is a consistent ratio, so that's a good thing, and widely used. The higher PE stocks we think of as growth stocks. Why do we call them growth stocks? Well, I'm going to show you in another few minutes that basically you can get a high PE by having a growth rate that's high. I'll show you how that. He was talking about the actually being explicit with your assumptions about K and G and so forth. I'll show you what he was headed towards there in just a minute. Value stocks are at the other end of the scale. So these low PE stocks that have, if not explicit, they have implicit low growth rates embedded in this analysis. And yet people think of these as, oh, these are cheap. This is what this is what Berkshire Hathaway is based upon. This is Warren Buffett's love are value stocks. Now, he doesn't pick all value stocks, you'll notice. And there's a reason why, is that maybe that growth rate assumption that's low is correct in many cases. Now, he's still what people call a value investor. He buys value stocks, but you'll notice that Berkshire Hathaway doesn't own all value stocks. They just own that select few that have made Warren Buffett one of the richest people on the planet. So it's important that you don't overlook those things. Just because it has a low PE, a low price relative to its earnings stream, or you can think of it. I like to think of PE. We're taking price over earnings. So we have that implicit 1 in there. So if we see something that's 10 or 9, that means I'm only paying $8 or $9 or $10 for $1 worth of earnings, versus a growth stock where I might have a PE of 30. I'm paying $30 for $1 worth of earnings. It's all a function of growth, though. If the growth rate of this high PE company is not also high, $30 for $1 worth of next year's earnings is going to just be a way you're going to be overpaying grossly for that. Likewise, over here, this growth rate is likely to be extremely low, and it could be that it's even lower than you think, and that even $10 is an overpayment for that level of growth. In fact, while we're talking about it, let me jump straight to that slide that I wanted to show you, and it's right here while we're on that subject. So here we're taking PE and we're trying to break it into its fundamental or intrinsic parts, make it look more like the formulas that we were just talking about, the dividend discount model, the residual income model, the free cash flow model. So if we start with right up here, that's our dividend discount model, right? Constant perpetual growth. We've got the dividend for next year in the numerator, and we have k minus g in the denominator. That's the closed form solution to an infinite sum, and that's DDM. Now, if we divide that by EPS, all right, and then do a little bit of algebra, not a whole lot, we end up with this. So the PE is a function of payout ratio, growth rate, and the required rate of return. Now, how does each one affect that ratio? Well, high growth firms will have higher PEs relative to low growth. All right, let's look at that. So we've got G here and we've got G here. Makes it a little more complicated to analyze, but let's think about if we increase G, well, the numerator is going to get bigger. And as we increase that same G down here increases, that's going to make the denominator smaller, which is also going to make the PE bigger. So yeah, in both cases, that actually has a big impact on PE. So a little bit of a bump up in G is going to cause a fairly substantial concomitant increase in the PE ratio. Higher risk firms will have lower PE ratios. So again, let's look at the K here. As we increase K, that makes the denominator bigger, which drives PE down. So those value firms that we might be finding, maybe they're just high-risk firms, disguised as value firms. And then finally, firms with low or lower reinvestment needs will have higher PE ratios. And here we go. So if I have a lower investment need, I can pay out more of my earnings in the form of dividends or repurchases. That means that numerator is going to be bigger and my PE is going to be larger. So this is what Aswath was talking about. That third part of it is to break it down into these fundamental things and be more explicit about what we're actually doing with these ratios and what's actually going on inside of these things. Because this is, I mean, you can see by the math, this is clearly PE is a function of these three factors. And as I change one or several of these factors, it's going to affect my PE ratio. Kind of a cool analysis, I think. Okay. A couple of other ratios. Price to cash flow is another ratio. Now, in this case, make sure that we're using cash flow to equity, not cash flow to the firm. If we're using cash flow to equity, then we have a consistent ratio. If you were using the cash flow that we were talking about earlier in the free cash flow model that the authors used, that would make it an inconsistent ratio. We wouldn't want to use that one, or at least not rely upon it. And again, the advantage of using price to cash flow rather than price to earnings is that cash flows are less easily manipulated by the accounting methods that we employ in any particular company. And they're more comparable too. So even if one company uses one method to account for its depreciation and or inventory and another uses different methods, if we look at price to cash flow, we wash all of that difference away. So there we're better able to compare PCF of those two companies. Then we've got two more that the authors mention. This first one, price to sales ratio, that one is a huge problem. That's hugely inconsistent, right? And again, when we talk about this consistency, I like to think about the income statement. We've got revenue up here. Down at the bottom, we have net income. So that first ratio, that PE ratio, the earnings stream that we're talking about comes from right here. It's the earnings that go to equity. But as we work our way back up the income statement, there are a whole bunch more people that get paid in here that aren't equity. Yet in the numerator, we've got price of equity. It's a lot of variation from one company to another in how much money goes out in cost of goods, which includes payment to employees, salaries, things of that nature. Then we still have debt to take out of it. So there's a bunch of things that come out before we finally get down to net income, and those things are going to vary from one firm to another. So using price to sales is a really, really bad idea. So why do people do it? Well, especially back when we were looking at the dot-coms back in the late 90s, that was the only figure on the income statement that was positive, was sales. By the time we got below, sales, everything turned negative. They were burning through money like crazy. So they had a high burn rate. That was the only positive value I could use, so people used it. Now, once the companies had been around a bit longer and were able to generate a positive EBIT, then they'd use that, and then hopefully eventually they get to generating a positive net income, and then you could use a PE ratio. But, this one, if I had a choice, I would never look at at price to sales, P over S. But in some cases, you don't have that choice. And then price to book is yet another tried and true, only second to price to earnings. So this also can be known, it's often talked about as market to book. You'll also see some people refer to it as book to market. Of course, you have to invert all of your thinking, but same thing here. We're talking about the market price of equity per share divided by the book price of equity per share. And again, ratios bigger than 1 suggests that the firm is creating value, but not always, right? Because we know that the book value of equity is a historical measure of what was invested in the company initially. And depending upon how old that company is, may or may not have any relationship to the true value that was invested or the value that it's worth today. So, still be careful with price to book as well. This couple of slides here just looks at an example here for Intel. And again, I'm going to point out to you, I mentioned this last class, I believe, but I'll point out to you again here. The textbook says, well, why don't we use Intel itself as the best comparable or comparable? And, well, why not? It's a great comparable because it is Intel 1 year ago or 2 years ago. So, and more than likely the company is more or less the same, assuming that management has been the same. So that has some real benefits. What we're missing there, and this is an important miss, is that we don't know that the condition of the market was at all the same. We could have been in an expansionary period and now we're in a trough, or vice versa. And we often see that the market mispricings are related to the business cycle. So using the company itself as the comparable or comparable is fraught with some real serious problems and kind of takes away from exactly what it is that relative valuation brings to us, which is it gives us the current market condition. So while this is, you can think of this as like a time series, what we're going to do in the security analysis is we're going to do what I would refer to as a cross-sectional type of relative valuation. And by cross-sectional, I mean that we're, instead of using the prior years of Intel's PE or price to book or price to cash flow, we're going to use comparable or comparable companies that are in the same business as Intel, competing for that same dollar, but we're going to use those current ratios. So we're going to take that average. So don't be confused once we start doing that. The textbook uses this, but this is definitely not the best practices necessarily. It's okay for exposition. So they take that 5-year average, they look at the current EPS, and then they estimate a growth rate of EPS. So we've got a little under 1% growth rate. We've got a current EPS of $3.22. So we plug that in, and we grow it at that 0.9% for 1 year. That becomes our EPS at time one period out. Then we're going to multiply that by the average or the comparable PE ratio. In this case, they're using that time series, and that's 15.9. So when we do the math, we end up with a value for Intel of $51.66. We compare it to the current market price, and we say, pretty close, probably within a standard deviation, so can't really say it's misvalued necessarily. Now let's look at price to cash flow. We're doing a similar thing, except we're using P over CF for the 5-year average, so the prior 5 years, and we have a price to cash flow ratio of 8.9. We calculate our cash flow per share that we just had this past year, and we calculate a growth of that cash flow per share. And then again, we plug in that growth rate, we plug in that cash flow per share, and we multiply that by the price to cash flow ratio over the past 5 years, and we end up with a price estimate of $27.50. Now that looks like it could be quite a bit lower, so maybe Intel is overvalued by a considerable amount. And then finally, using price to sales, which again, this is internally inconsistent, but people still use it, unfortunately. And again, our last 5 years average was 3.1. Current price to sales is 14.7, and the expected growth rate is 3.1%. Do the math, and we come up with something very close to Intel. Now, the one advantage of using Intel as the comparable or comparable is that, yeah, it's probably got the same cost structure, same debt as it had for the last 5 years. So in that case, the inconsistency in this ratio is not a problem because we've already controlled for those differences. Now, that's assuming that Intel hasn't changed any of those things over the past 5 years. Okay, but you can see the variation that we get in looking at just 3 very simple, very popular ratios. Considerable variation in the output that we get for an estimated stock price. Another popular numerator, so we've looked at a variety of denominators. We've looked at sales per share, we've looked at earnings per share, cash flow per share, but we've always had price in the numerator. Another popular one is EV. This was something that Aswath also mentioned. EV is enterprise value. Now, enterprise value differs from firm value. Firm value is simply the sum of the market cap of equity and debt. Enterprise value is that same value, that firm value, and then we subtract off the surplus cash. Oops. And I emphasize surplus here, and that's because there's a certain amount of cash that's necessary for operations. We don't want to deduct that amount of cash because that's part of the operating capital that we need. But firms often have more cash on their balance sheet than they necessarily need. When you subtract out that surplus cash, you're really just getting it down to this is what the firm needs in terms of an asset base to function. That surplus cash is going to get whatever rate we have it invested in, and we don't need that to value this firm. So here's how we go about doing that sort of valuation. We'd look at EV to EBITDA, that is earnings before interest, taxes, depreciation, and amortization. And if we start up here, we've got Courtney's Kayak. Equity is worth $800 million. Debt has a market cap of $300. and we have 100 million of surplus cash. So then we're going to jump over. So we've got 1 billion in EV, enterprise value. That's 800 plus the 3 minus the 100. Then we're going to jump over to the income statement, and we're going to go down here and we're going to calculate an EBITDA, and we end up with a 200 million EBITDA, and we take the 1 billion over 200 million, and we end up with a EV to EBITDA of 5 for that particular firm. So, and by the way, here's our EBITDA. And again, we can get comparables. We can get their average EBITDA from the comparables, and then apply it to the firm's EBITDA that we grow for 1 year at the growth rate of EBITDA. So same basic method. We're just using a different numerator here. Another thing that, and I don't think Aswith got into this, I think he does in the last couple of minutes. Here's something else about PE. When we're describing PE and calculating PE, why is my PE different than your PE, different than somebody else's PE? Well, here's a possible reason. Both in the numerator and in the denominator, we've got different measures that we can capture. Okay, so in the numerator, one way of calculating that is simply grab the current price. Why the current price? Because, well, one could argue that that current price is most reflective of what's going to be happening out there in the next year or 2 or 3. But others will say, well, wait a minute, that denominator, if I'm using the trailing 12 months, that denominator is over the last 12 months. So why don't I take the average price over the last 12 months? Or maybe I take the month ending price over those 12 months and average that together and use that as my numerator. Likewise, in the denominator, I can use a most recent financial year or fiscal year, which may or may not be also equal to the trailing 12 months. Trailing 12 months is the most recent 12 months. If my fiscal year ends in December 31, then and we're here in July, trailing 12 months is going to be quite different from the most recent fiscal year. So the most recent fiscal year will be 2020, from January 1 to December 31. The trailing 12 months will be June all the way back to July of 2020, beginning of July of 2020. So there I'm going to have different measures, even in historical data. And then this last one, forecasted EPS. So I actually have to figure out what's EPS going to be in the future. And I think right now we have an example of that being extremely misleading. If we look at the trailing 12 months or we look at the past fiscal year PE ratios, look at what the market's been doing, right? It's been going through the roof. And we compare that to earnings over 2020. What were earnings like in 2020 for most firms? Other than some of the tech firms like Zoom and Amazon and so forth. They had good earnings, but everybody else, pretty bad earnings. Right? So if you put that really high price number over some pretty bad earnings, you're going to get PE ratios that are way, way up. So you're going to get PE ratios in 30, 40, 50 range for companies. That's a sell signal to most people. But remember, the market is forward looking. The market is saying, well, wait a minute, we're coming out of this pandemic. You can debate, how quickly and so on and so forth. But generally speaking, I think everybody agrees that we're going to get out of it at some point in the not too distant future. So those earnings are going to be better in the future. And if my market is actually looking at what's happening over the next 12 or 24 months, then the correct measure is this forecasted EPS. not the historical stuff. And when I use a much higher value, which I'm assuming that's what I'm going to find for forecasted EPS, then all of a sudden my PE ratio drops back down to where I go, yeah, that's kind of normal. High teens, low 20s. Yeah, market isn't overvalued. No need to worry about it. No need to run away and put my money into safer securities. So these things are really terribly important. You might think that it's, hey, I just get a price, I get a EPS, or I just go to Zacks and let Zacks do it. No, please don't do that. Or even Bloomberg. I mean, Bloomberg is definitely trying to do a good job, and they will give you a forward-looking PE. But even at that, maybe your estimate of forecast earnings is going to be different than Bloomberg's. Okay. We already did that. Here, let me just bring you up to this graph. Couldn't find anything more recent in this, but even back in 2020, late 2020, stock prices were going up, and so we saw PEs pushing into the 40s. And this is for the S&P 500. This isn't just some, one stock that's crazy overvalued, or maybe it has high earnings in the future. So here we're talking about all the S&P 500 securities. Notice also right here, that it was way off the charts, way up into the high double digits. That looks like it's crazy overvalued, but indeed, since this is a trailing 12 months, it's not. It's just that earnings were lagging the prices that we saw in the market. And here's a slide just kind of showing you trailing versus forward looking. If you, I won't spend any time on it. You can come back and look at this. But the idea is that somebody has estimated forward and compared that to the trailing 12 months. And you'll see that it's quite different. And it varies from period to period, obviously. One last thing, and I think we're getting close to needing a break here. I think this we're just about, we're just about at the end of the chapter. I think timing is going pretty well. Another thing you need to think about is when I'm looking at multiples, maybe I've got some comparables that are better than others. If I equal weight the average, I'm throwing in some not so good comparables or comparables with some relatively good ones. Why should I do that? Maybe I ought to just weight them on the basis of how much confidence I have in that firm being a good comparable for the subject firm, for the firm I'm studying and trying to value. So there's certainly some wisdom in doing some sort of weighted average as opposed to assuming that they're all equally weighted. Don't make that mistake. Also, another thing that you should think about is that as far as picking a multiple, there may be one multiple that is much better than others for your particular purpose. And again, as was mentioning, there are some multiples for specific industries. There might be price per click, or it might be price per ton of steel, or it might be price per square foot of retail space. And those may be the best multiples to use. Why bother with the rest? And why average good with the bad and end up with kind of a mucky estimate? Use your judgment. Come up with that one estimate or that one multiple that you think is more valuable. Also, likewise with the comparables. If you think that one comparable is much more close to the subject firm, maybe put a bit more weight onto it. And then the rest of these slides just go through an example. I'm going to kind of cut to the chase. And again, you see they run through the various models, both intrinsic and relative. And you can see, let's see, what was our original, I forget what we're at $66.82 in the market. All right. And then, they were using real world data and plugging into these various models. So remember, $66 was the market price. And we're getting everything from into the mid 20s on up to 118. Now, it's kind of convenient that that 118 came out of the price to sales model because we know that that's inconsistent. I would just ignore that one. But we're still coming up, even in the PE model, relative valuation, 63. Well, that's actually kind of close. Price to cash flow seems a little bit low. The free cash flow model seems a little high. And of course, these other methods, the intrinsic methods, seem a bit low. And I'll let you work through that. You can kind of use that to test your ability on calculating these various things. They give you the data back here. And you can use that to calculate the various ratios and intrinsic methods. And that's pretty much it out of. Oh, okay. So financial statement forecasting. Let me jump out of the way here. They're going to use this example. Suppose that you're an analyst employed by Vulcan Ventures, and you're assigned as to analyze the Borg Corporation. And this is a few hundred years out into the future. So we're out in 2536. And Borg announces a completed acquisition of some distribution outlets from Klingon Enterprises. So they're having fun with the names. The stated purpose of the acquisition is to increase sales. Borg also announces plans for a marketing campaign with the goal of increasing the sales to 137,500, which for being in 2536 doesn't sound like a whole lot of money to me. That could be in a different currency, though. Okay, so what do we do? How do we proceed? Well, we've got a couple of ways we can do pro forma financial statements. One of them, and this is probably what the accountants in the room are more familiar with it, and that's called the analysis of accounts. It's a very detailed, very precise way of estimating your cash needs over the next 12 months, right? That's typically what accounting folks use analysis of accounts for. But it's also very time consuming. And the level of precision that we need here and that we could even think is useful is questionable when we're doing a security analysis and we're projecting out 5, 7, 9 years into the future. There's a second method, which is much simpler, and that is called the percent of sales method. And that's what we're going to use, is this percent of sales approach. And in fact, now you may want to even use kind of a blended approach. There may be some things that are part of this percent of sales method that just don't make sense for Sherwin-Williams in particular. And if that's the case, then do more of an analytical type of approach, analyze the accounts, be more thoughtful about how they relate to sales and the other accounts. So I think that's a good approach. But start with the percent of sales, and then you can tweak it as you see fit. So here, with the percent of sales, each account, we're assuming that each account increases at the same rate as sales. And we're going to do that with all of the income statement accounts and a select number of the balance sheet accounts. So we're going to start with the level of sales is supposed to be 137.5 for the year 2537. This is a 25% increase over the prior year 2536. So the ratio of the total cost to net sales is about 94.5% in 36. So we're going to assume that it's also the same percent of sales in 2537. So 95.55% of the 137,500. That would be our total costs. Depreciation can be handled in a variety of ways. One, you could assume that you're going to continue with the same depreciation because, well, are we going to increase assets or not? We don't know. In fact, that's one of the areas where we can deviate from percent of sales because depreciation is such an unusual animal. It's not unrealistic to assume that many costs are going to go up as revenues go up, but in terms of fixed assets, that's not always going to be the case. Another thing we need to think about in conjunction with this discussion about depreciation is, do we need to increase the fixed assets? How much capacity do we have that we're not using? So if we have any excess capacity, maybe we're only at 75% capacity, and we could do this 25% increase without actually increasing our fixed asset base. So depreciation could continue along at the same rate. And again, these are things that you'll have to make a decision based upon the particulars of the company, in our case, Sherwin-Williams. But they give you an example of how you might do that. So the depreciation in 2536 was $3,000 on $110,000. So that's the sales level. So as a percent of sales, that's it times the 137. So they say, well, let's assume that depreciation goes up. So that assumption suggests that maybe plant capacity was at 100%. And we actually had to increase our fixed asset base, which increased our depreciation. But again, your mileage may vary on that particular account. Some other assumptions that we have to make. We have to figure out what are our rates on various terms of loans, so short, long-term, that sort of thing. 5% interest on debt issued to finance new outlets. We're going to also figure out, are we going to keep the total cost to net sales for the operating expenses? Tax rate is 40%. We're going to assume dividends are a constant percentage of net income. And again, is that realistic? No. In particular on dividends, right? Because dividends we keep as a very stable stream. So even if net income goes up, we're not going to raise dividends with net income. They're not going to vary. So again, I leave it up to you as an analyst. You can go to an extreme. You wouldn't want to do a full-blown analysis of accounts treatment for this, but there are certainly specific accounts within the balance sheet and the income statement where you might want to do actually a little bit more work and fine-tune the percent of sales method. Questions so far? Oh, and I'm sorry, on this, let's see, on this second point, to maintain this, we're using use the operating expenses as a plug, and what they mean as a plug, that gets us to the increased amount of costs. We use that as the account that we change. We don't have to change all of them. So here is a pro forma income statement, and the pro forma part obviously is just this 2537 part of it, and here is the current income statement. So you see how sales goes up by 25%. We also have our cost of goods sold going up by a similar amount. Operating expenses go up by by 2,500. Interest expenses go up. Income taxes obviously go up because our pre-tax income went up. And so here is our net income. And then we've got retained earnings. And now notice, where does retained earnings go after we close the books? Let's see, Benjamin, Matthew, you're both accounting majors as well, right? Where does that retained earnings go to? I know I put you on the spot, sorry.
You mean like how it goes into stockholders' equity?
Yeah, exactly. Yeah, so that retained earnings figure actually goes from the income statement and goes over to the balance sheet, right? So we got to take that into account. All right, now onto the balance sheet, in fact. So now, whereas on the income statement, all the elements, all the accounts within the income statement spontaneously changed with sales, not all of the asset accounts are going to change with sales, nor are the liability accounts necessarily going to change with sales? And again, we also we have to make some assumptions about what's going on here. So the asset accounts that we are going to have vary with sales are going to be the cash, accounts receivable, prepaid expenses, materials and supplies, and inventory. You'll have to decide, depending upon the capacity and the expectation of any fixed income or fixed asset expansion that the company is planning on making, whether those accounts are going to need to change, and if so, by how much. That may not be directly related to sales. It may be more of a step function. The only liability account that you're going to change as a percent of sales is going to be the accounts payable piece of it. And then we've got a few other accounts that are going to be, again, plug accounts. Because the fact is that when we change these guys, and only this part on the right-hand side of the balance sheet, and then we bring retained earnings into the equity piece of the balance sheet, my guess is that unless we're really, really lucky, the balance sheet isn't going to balance. We're going to have to figure out how we can force that balance as well. So when we do that, here's what we get. So here are the accounts that vary with sales. And here's the percent of sales that they are. So, going from 25.36 to 25.37, that goes up by 25%. And or you could just say it's 1.8% of the 25.37 sales. The nuts and bolts of how you do this in the spreadsheet in terms of formulas are up to you, whatever makes more sense to you. And then likewise with the accounts receivable, prepaid expenses, materials, supplies, and inventory. The only account that varies directly with sales down here is the accounts payable. And again, that goes from 5,000 up to 62.5. And you'll notice also the retained earnings. We're going to take that, 3,150 in retained earnings, and that's going to be added to the equity retained earnings account. So that goes up to 33,150. Now, they've made some other changes here. And they'll talk about that in the next couple of slides. But you'll notice that in this case, in this particular balance sheet, that these two figures, using my fingers instead, they don't balance. So we're going to have to make those changes. They've also shown you the external financing need. That means that in order to have an asset side of the balance sheet equal to 110,000, we're going to have to raise some funding. We're going to have to raise some financing. So we're going to have to go outside the company to get that financing. We can do that in the form of debt and or equity financing. And again, assumptions are going to have to do with what you think the company is most likely to do. Matthew, you had a question?
Yeah, so with that pro forma balance sheet, is there anything that you would do regarding either retirement of shares or buying or selling treasury stock or issuing more?
Yeah, absolutely. You could. I think the question, at some point, the question always becomes, is it an improvement that is, or is it a change that is going to alter the essence of our value estimation? And if the company does do a lot of repurchasing and things of that nature, yeah, we absolutely want to take account of that if we can. Also, let me say, for all of us doing this exercise, for you all rather, I should say, this is, I'm assuming this is the first time you've ever done something like this. And I don't want you to get lost off in the weeds. And I don't mean to say that the weeds are unimportant. The weeds are still important. But in order to get this done and do it inside of, we're going to have around a month to complete this, a little less than a month to complete this entire exercise. And I know there are 3 of you in the team, but believe me, once you start getting into it, it's a lot of work. So I will leave it up to you. If you find that there's a need that is particular to Sherwin-Williams that hasn't been addressed, let's talk about it. I can help walk you through things if you want to make some other changes and make the pro formas more robust. And I'd encourage that, but I don't want you to do that to the exclusion of looking at the big picture as well. Does that help? I mean, what we're going to come up with at the end of the day is not what you would ordinarily see an analyst come up with, because this is a very complex task and it requires some experience and practice before you get really good at it. And a lot of the things that we're doing, for instance, the spreadsheet. An analyst is going to have a spreadsheet already pre-built that does pro formas. All they need to do is do a little tweak here and a little tweak there to make it match the company that they're particularly working on. For you all, you don't have a spreadsheet. In fact, I'm going to ask you not to come in with a spreadsheet, even if you have built one before. I want you to build a new one. So that's going to take a fair amount of time as well. But yeah, I'd encourage that if you have the time and the ability to play around with some of that stuff. Absolutely, that can add value to the recommendation for sure. Sure, absolutely. Any other questions so far? All right. So here we are. We see that assets go up by 22,000 without additional financing. Liabilities and equity, however, only increased by 4,400. So we have this external financing need, EFN. How are we going to deal with that? Well, we deal with it by whatever seems to make the most sense, that's going to give us a financial statement that we think is going to look most like what the company is going to look like in 1 year or 2 years or 3 years and so on. So as a result, what they've done here is they've said, well, let's split that external financing need up. Let's make part of it short term. So we're going to make 2,500 of that short term. And they already talked about the rate back here. Our short term interest rate was 4%, 8% on long term, and 5% on debt issued to finance new outlets. So 4 and 8. So this will be at 4%. And then we have 15.1 that we're going to finance using long-term debt at 8%. Now, remember, that's got to feed back. Those interest costs are going to feed back into your income statement in the next year. So this thing, you've got to connect that income statement with that balance sheet. And I want you all to use formulas to do it. The video that I have for you to look at next week as part of your classroom assignment goes through that in some detail. So especially if I want all of you to see it, but especially if you happen to be the team member who is going to be maybe not exclusively, but primarily working on building that spreadsheet, pay really close attention. You might want to watch it a couple of times just to make sure that you get the gist of it, because there are a lot of interconnections between these things. So when we do that, right here, we've got our short-term debt going up by 2,500, and we have our long-term debt going up by 15,100. And lo and behold, now our liabilities and equities balance with our asset side of the balance sheet, and all is good in the world. Okay. And then we could go on to the next year. Another scenario to consider, though, they say, well, look, we've got, assume that Borg was using its fixed assets at 100% capacity. This means, in the last one, sorry, they were assuming that. But let's suppose that maybe it's only 75%. And as a result, we could actually increase capacity and still support a revenue of 146,600. We're only at 37.5. So we wouldn't need to do anything with our fixed assets in that case. and that changes the need to get external financing. Let's see. Then they also go in, they projected profitability and price ratios. So you're going to extract that out of your pro forma financial statement. So you can get your gross margin, operating margin, ROA, ROE, book value of share of equity, earnings per share, and cash flow per share. And again, that just comes out of the pro forma just as you would out of any ordinary financial statement. So that's pretty much it in a nutshell. Now, once you've got that, the next step, and I don't think I've got it in here. Yeah, and I'll have to, I think I'll have to do one more video because I did not include this in the video that you're going to be watching next week. But the next step, once you have these pro forma financial statements, what I'm going to want you to do is to calculate the free cash flow to equity. And that's very similar to what we did when we calculated the free cash flow to the firm, just a couple of little tweaks to that formula, and we have free cash flow to equity. And then you're going to take, for instance, I think, correct me if I'm wrong, I think Sherwin-Williams, I think they have a 12/31 fiscal year end. So we're midway through their 2021. So our most recent is going to be the 2020 10K. So we would dive off from there. So we would be projecting out the 2021, 2022, 23, 24, and oops, running out of space. 21, 22, 23, 24, and 25 for Sherwin-Williams. So you've got your income statement, you've got your balance sheet for each of these years. Then you're going to calculate a free cash flow to equity for each one of these years. Oops, my bad. So you're going to have 5 free cash flows to equity. Then one last thing that you still need to do out here at year 2025 is you need to come up with a terminal value for the value of the firm ongoing beyond 2025. And you're going to add that to that free cash flow to equity. And that's going to be your 2025 cash flows. Oops, keep going on. I've got a 4x3 writing pad here and it's all black and I can't tell. I've got a 16:9 screen. Sorry, keep running off the edge of this thing. All right, so we've got the 21, the 22, the 23, the 24, and the 25 cash flows. We're going to discount those guys at our cost of capital. And we're going to discount that one. Let's see, it's actually 1 plus K, right? 1 plus K. And 1 plus K, raised to the third, 1 plus K, raised to the fourth. And finally, we're going to discount this one by 1 plus K, raised to the fifth. We're going to add all those guys up. And that's going to be our discounted cash flow value of Sherwin-Williams. And we're doing this on aggregate value, so we're doing this on the total value of the company. So once we have this value, we'll probably want to get it on a per share basis, so we'll divide it by the shares outstanding. And that'll give us a dollars per share. So that's where you'll be heading once you've done these pro forma financial statements. One of the other things, I want to emphasize this because a number of the teams in the spring had to go back and rework a lot of their spreadsheets. And that is that I want to be able to go into that spreadsheet and change your growth rate assumption and have everything in the spreadsheet update. Income statement, balance sheet has to balance. All the cash flows have to update. and they have to discount back and get summed up and give me a new valuation. So everything has to be a formula. Don't just plug in fixed values. Remember, that's the real beauty of a spreadsheet, right? Is that you can do some scenario testing, you can do some what if testing, and change one of the values and see how that affects the valuation. You could change your K, you could change your G. If we had more time, we could even start using one of those Monte Carlo plugins to Excel. There are a couple of them on the market. Crystal Ball is one of them. At Risk is another one that's like this, At Risk, if you want to look it up. If you're into Excel, if that's kind of like your meat and potatoes, you're good at it, you may have already heard these things, or you might want to even download it. There's we don't have any copies on our new data analytics floor yet. Hopefully we'll have one of these, or maybe both. But you can download and get like a trial free version for a couple of weeks. So if you wanted to play around with that, I'd be happy to walk you through that as well. That's where we're headed with the pro forma stuff. I don't believe, I'm not going to go through this Starbucks example. I'll just leave that for you to walk through. And I think that's it. Otherwise, yes, that is it. So questions about Chapter 19. Anything else in there that didn't make sense to you as you read it? Don't feel bad about asking a question because I've got more things to do. It's not like we're going to end class. It's, we've got another, 35 minutes. Okay. All right. Well, then let me jump over to Chapter 20. Just got a couple of things to talk about in Chapter 20. And we're going to start right there. Okay, so the way this chapter is, the way they talk about these types of analyses in this chapter is they're thinking about it in terms of how do you filter for a subset of firms that you might want to buy. And so that's the language that they're using here. The techniques, though, still apply to what we're doing. It's just that we've already picked the firm we want to analyze, and we're going to use the same techniques to analyze them. So this idea of a top-down analysis still applies to the case that we're looking at. But that's why when you're reading this, you may go, well, wait a minute, how is it the same thing as what we're doing? And the answer is it's not exactly the same. They're starting with the entire universe of firms, and let's use these methods to narrow it down to the 100 firms that I want to put into my portfolio. All right. And what we're saying is, hey, we're just going to pick this one firm that we want to analyze, and we're going to use those same techniques to understand how that firm fits relative to other firms and what its value should be. So this idea is really, I think the picture here is worth 1,000 words right there. That's what we're doing. We're starting at the very top. We're starting, in our case, we could start with the global because Sherwin-Williams is a multinational corporation. Certainly, we want to start with the U.S. I don't know what percent of the revenues at Sherwin-Williams are derived from the domestic market. I would suggest that it's probably a large percentage. So we may be okay just by focusing on the U.S. Or we might want to pick the top 2 or 3 regions, and we could look at the whether their economic forecasts are differing. All of that stuff is available on Bloomberg, so it's relatively easy to get. Now, if you were an analyst in a company, you would have your in-house economist who is going to actually provide you with that data. You could certainly use Bloomberg, but you're going to have somebody who's an in-house expert who might want to fine-tune that a little bit for you. Then we're going to drop down. We're going to do an industry analysis. We're going to look at the strength of the industry, where it's moving, what's the projected growth for the next 4 or 5 years in that industry, where does Sherwin-Williams fit within that industry, and then we're going to go down at the company level. We're going to look at the internal metrics in the company. employees, management team, structure of the board of directors even. And then we're going to go out either side. We're going to look at suppliers. We're going to look at customers. We're going to look at sustainability, environmental sensitivity, and certainly Sherwin-Williams has things related to that, given that the chemicals that they use have to be dealt with in a safe manner. So we're going to look at all of those things and then try to put that picture together and see what Sherwin-Williams is worth. Some of the things that are going to be important to Sherwin-Williams are, and any company for that matter, is the business cycle. So where are we at in the business cycle, and where do we think we're going in the business cycle, and how long is it going to take to get there? So are we at a peak? Are we in contraction, trough, expansion? Well, that's something that you'll want to go to Bloomberg. You want to do some research and figure out where it is we're at, and where will where will Sherwin-Williams go if we are in an expansionary period? Is that a good thing for Sherwin-Williams, or is it just okay? Are they fairly stable over time or not? That's another thing you want to get some sense of is how does Sherwin-Williams profits and revenues vary across the business cycle, across the various stages. So another thing you could do is to go back to the last business cycle, which is a long ways back. You could go back to the financial crisis. You could even go back to a prior business cycle before that, if you want something more typical, if you will, and see how Sherwin-Williams performed there. So those are some additional things you could do, not required, but certainly if I were an analyst doing this with real money and my job depended on it, I would want to know. Absolutely. So sorry for the sirens. So that's the business cycle, and of course that relates to real GDP. If we go back to the late 1950s all the way through 2018, looks like it's been pretty much nothing but up. But if we look at it on a year-by-year basis, now we get a little more clear picture of what's going on here. Notice, too, that the zero line is right here. So there have been some pretty bad periods of contraction, in particular around the financial crisis and back into the 80s. But since the financial crisis, we have had a relatively unprecedented period of pretty good growth. I mean, it's not been off the charts good, but it's certainly been relatively stable. We haven't had a contraction. We certainly did have a self-imposed contraction last year, but that wasn't because of the business cycle. The business cycle we think of as something we can't control. That contraction was due to something we chose to control, also relatively unique. Want to think about how do companies fit into that, and that's what I was talking about earlier. Where does Sherwin-Williams fit into that? Is it cyclical or is it defensive? Cyclical is the dominant strain of companies. That's why it's a business cycle, right? Most of the companies go into an expansion, then we hit a peak, and then they contract, and then we hit a trough. That's why the business on average. But there are some companies that actually are the reverse of that. We can always think of, like companies that produce spirits and alcohol. Maybe they're even better in bad times as we try to self-medicate, or something like that. Or you think of cigarettes, highly addictive, and so maybe they're very stable over time. I think paints, I don't know. I honestly haven't looked at it. I'm kind of thinking that's a fairly stable business too. Even in bad times, I may not be buying a new car, but I may still be repainting my old car. I don't know. We'll have to see. That's going to be up to you guys to find out. So anyway, keep that in mind. We want to see how does our company in particular fit into that business cycle. Does it follow it, or is it counter, or is it relatively stable? Leading, coincident, and lagging indicators. Again, this goes back to probably your Econ 101, so I won't belabor it too much. But these are the guys that we're really looking at to try to get some sense of where we're headed to. But we also want to look at coincident indicators to actually provide some confidence that we know we are at this point and that we are heading into whatever different part of the business cycle it is. And then the lagging indicators, those that are trailing. So that's telling us kind of where we have been, average duration of unemployment, that sort of thing, ratio of trade inventories to sales. But in particular, we might want to think about those stock prices. Stock prices are definitely a leading indicator. Investors try to use all of that information and embed that into the buying and selling decisions, and that embeds it into the price of the market as measured by the S&P 500. So the stock market is a very good indicator. Right now, the stock market is really strong. We're almost at closing of 35,000. I think we've actually passed 35,000 in intraday trading, but I don't think we've hit a close at 35K yet, which is pretty darned amazing given where we've been over the last couple of years. And given that this has been a relatively bull market since 2009. People like myself who've been through a variety of business cycles kind of keep going, okay, when is the bottom going to fall out? We know it's going to fall out. Oh, we're going on, 12 years and the bottom hasn't fallen out yet. What the heck is up? I don't think it can go on forever. But on the other hand, there's no indication that it's about to turn right now. In fact, if anything, we're hitting putting the pedal to the metal, really. There's huge spending by the government, individual spending. On average, now mind you, I don't want to diminish the pain and suffering that many have felt, but on average, you look at the average middle income earner, they're probably sitting on more money than they ever have for the last decade or more because they didn't spend it. So there's every reason to believe that this growth will continue. Now, I'm not a macroeconomist. I don't play one on TV, and so whatever I'm saying here is probably wrong. We'll go to Bloomberg for the real deal, but that's just my personal opinion about where we're at right now. We also have to think about exchange rate risk, and Sherwin-Williams certainly has some exchange rate risk that I suspect they need to deal with. How much of it is there, and how do they manage it? Do they hedge it? Do they just try to sell everything in dollar terms and then push it off onto somebody else? You need to dig into that and figure out how it is that they manage that sort of exposure. I'm not going to go through that example, but I'd certainly recommend that you think about it as one currency appreciates, the other currency depreciates. We're always talking about pairs of currencies. We're talking about dollars versus euros, or euros versus yen, or dollars versus yen. Industry analysis is another important element. Look at the industry. You want to find out the position of Sherwin-Williams within the industry, market leader, market follower, where do they fit in the pack, that sort of thing. How much, and also how much potential growth is there in that industry? Are we in let's see, let me get to the cycle. Where are we in this industry life cycle? Paint, I'm guessing we're somewhere-ish in this vicinity. But that's not to say that a particular company might not have some really good innovations that kind of shift them back more towards this rapid increase and increasing growth stage, if not at least stable growth stage. When we think about industries, we should first focus on sectors. A sector is a much bigger slice of the business pie. And so we've divided things up into a variety of sectors: materials, energies, financials, real estate, industrials. Where does Sherwin-Williams fit into this sector category? That's certainly good to know. It doesn't tell you a lot because there's such a broad swath of businesses, and some may be very unrelated to the others. I think your authors talk about Starbucks versus Ford. Are they really the same? I don't know, but they're both in consumer discretionary. You know, I don't think they're quite the same, though. But it still does help us to know, is that sector expanding? Is it growing? Or is it contracting? Is it staying about the same? Another thing I want to point out to you all, look at financials. All right. You're all focused on finance as a career path, or at least thinking about it. If you're an MBA student, you're not necessarily majoring in finance, but you've got an interest in it. Look at that. 13.25% of market value back in January of 2019. Now that's varied a lot. It's gone up above 20%. And this is kind of a low point, really. It could be well above that right now. I don't know what the number is, but I mean, you compare it to something like, hey, healthcare is a great area to get into too. Yeah, not very far off of healthcare. Huge fraction of the economy is driven by those two sectors. Certainly, technology is way up there right now, but again, like I said, finance has been up in the 20s too, the low 20s, high teens. The other interesting thing about finance as a career is that this sector includes things like banks, financial institutions, things of that nature that are directly, and their primary business is finance related. It's asset allocation, it's borrowing and lending, intermediation, that sort of thing. It's helping investors transact. All of that stuff is captured in there. But the undergraduate program here at John Carroll is not only training individuals for that sort of career path. You can go down to the Cleveland Fed and get a job with government. You could certainly go down to Key Bank. You could go to Huntington, PNC, any of the accounting firms. But you can also go into corporate finance, which really that captures all of these guys. So you're just getting an incredible exposure. I mean, you could actually join that healthcare end of things by being a financial analyst in healthcare over at the clinic. They've hired a number of our students. You could also do the same thing. Tech firms need finance people. They need people who understand startups, who understand how to get angel capital, how to move the company into that next category of funding and so forth. So just as a side point, thought I'd bring that to your attention. It's kind of interesting how big a chunk of the economy finance actually occupies. So when you add the financial components of all these other industries, we're well up into the 20s. Subsectors, obviously you want to get it down to a little finer gradation, granularity, where you can think about, well, it's not Sherwin-Williams versus, I don't know, an aluminum manufacturer. It's Sherwin-Williams versus another coatings manufacturer. And then we can even, one thing I should mention here, GIC, the Global Industrial Classification System. There's the NAIC as well, North American Industrial Classification System. And then there's also the SIC codes, which are the standard industrial classifications. This one is no longer the only code used. In fact, I thought it had actually officially been sunsetted, but you still see a lot of people talking about SIC codes. So those are 4-digit codes. And so the this first digit is sector, then the second gets you into subsector, then industry and sub-industry. But a similar pattern is used for these other two measures. And you'll want to use those certainly to figure out where it is that Sherwin-Williams thinks it is relative to other firms. Talked about life cycle. And then the last thing here that I wanted to, actually we're going to be done a little bit early. So Porter's 5 forces. And this was developed by Michael Porter, strategy guru. The 5 forces help us to think about where the company is. Sort of, you've all heard of probably the SWOT analysis, strengths, weaknesses, opportunities, and threats. The same sort of idea, more or less. One of the factors is threat of new entrants. So Sherwin-Williams, who's competing against them? How easy is it to get into that business and compete directly against Sherwin-Williams? Bargaining power of suppliers. So they're buying chemicals, they're buying various pigments. Are those suppliers big enough that they can dictate the terms of the agreement to Sherwin-Williams, or is it the other way around? Bargaining power of buyers. Likewise, just on the other side of the supply chain, right? And then threat of substitute products. So if I don't use paint, maybe I galvanize something. Is Sherwin-Williams, anybody know if Sherwin-Williams, do they do powder coating chemistry as well? They do, Claire? Okay. So that wouldn't be a substitute product for Sherwin-Williams, but if you just made paints, maybe somebody who makes the chemicals for powder coating could be a substitute product. What else? What other substitute products would there be for paint? I don't know. I'll leave that up to you. And then intensity of the rivalry within the industry. So how competitive is it? That's going to help us to figure out what sort of margins we have. Where are we in that pecking order, if you will, too? Is Sherwin-Williams at the top? Are they in the middle? Are they at the bottom? And it's not just based on size. It's based on, whether they actually are the market leader. Are they or maybe they're out there developing a lot of new products, developing new categories of products. And that might make them highly competitive. And I think that's pretty much it out of that chapter. Questions? No? Everybody's going, no. If I ask a question, my classmates are going to kill me because it's only 9:01 and we'll be out of here at 9:02. I understand. That was a dumb question on my part. All right, so let me just give you a couple of minutes or a minute of where we're headed to. Next week, I'm not going to be able to do synchronous sessions, so you've got the pre-recorded stuff that you can look at. There are 3 videos on the stock market. One of those videos, I think it's the 3rd one, includes applications for chapters 5 and 6. So you'll want to work through those. Think of those as like a supplement to your homework. You will definitely see some of that stuff on the midterm. By the way, in that particular group of exercises, let me see here. So where are they? Okay, so oops. Again, let me get out of the way. Here are the applications for chapters 5 and 6. So when you go in there, what you're going to find is you're going to be using the value line page. And this particular one is for American Express. That value line page is available right over here in that same resource section. And where did it go? Oh, here we go. So this is this is information that a company called Valueline puts out. Basically, it's a snapshot of the company on a single page. It's highly dense information and still widely used today. It used to be that, before we had a lot of internet, hey, Valueline was really valuable. It's still quite valuable because they put so much in one page. These are some of this timeliness, safety, technical, that's some of their special sauce, secret sauce metrics. We're not going to be using those so much, but we are going to be pulling data off of this page for those exercises. So, for instance, take a look. Here's a beta. In this particular case, American Express has a beta of 1.1. Price plot. We've got a variety of metrics going way back to 2009. So we've got 11 years of financials, basically. So we've got EPS, we've got dividends, we've got book value of equity, average PEs, total assets, loans, whole bunch of goodies in here. We've got return on shareholder equity down toward the bottom, retained to common equity, and so forth. So it's a really dense accounting of each individual firm. So we're going to use this in those exercises. So as you're going through that slide deck, working through those problems, make sure that you've got a copy of this sitting next to you so you can see where the numbers are coming from. By the way, if you're unfamiliar with Valueline in general, I've got a little bit of a primer right here. I'll move this. Right now it's on day 3. I'm going to move it down to down here to day 5. But this basically walks you through how to read a Valueline page. Right. So this tells kind of a little index to everything on that page. So work through those. There's another set of problems up here under day 2, applications for 2 and 3. And again, just more practice in working through problems very similar to what you had in the homework. So here we're going to do some leveraged long positions, margin long positions. We're going to do some short positions. So work through all of this stuff. Anytime you run into a question, probably the best spot, go to the discussion forum. I'm going to make sure I monitor that. So if you're not sure where a number is coming from or what I'm doing in a particular part of this exercise, these applications, or on the chapter 5 and 6, post it in the discussion forum for homework. That's one of the top 2. They're pinned at the top. And I'll answer it there. If somebody else sees it first and has an answer, jump in and do that. But then that way, you won't have to individually email me. You can always, if you've got a question, first look at that discussion forum, and maybe your question has already been answered in that. So work on those. The exam, I'm going to gauge it to be about 75 minutes. I'll give you the entire class period to work it. You're going to be allowed to have your formula sheet, calculator, and a pencil and a scratch paper. I am going to ask that you use the lockdown browser and that you use the, what do they call their camera system? You're going to have a video cam and do a scan of the area, that sort of thing ahead of time. So make sure that you're all set up and ready to go on that. I'm assuming that most of you have already gone through that drill multiple times over the past year. If you haven't and you have any questions, feel free to ask. There's some videos that you can take a look at, excuse me, with the lockdown browser. And I'll answer any questions that you may have regarding that. What else? Anything else about the midterm? Because really, I mean, we don't have any official synchronous meetings between now and the midterm. I will post a video link in the Zoom part of Canvas for our 5 p.m. Sunday review session, and that is Sunday on, let's see, that is going to be Sunday the 25th. and that'll be at 5 p.m. And I'll record it, but I'm not preparing anything for that session. So if nobody shows up, there won't be a recording. If you don't show up with questions, the recording will be very short. Or if you do show up but have no questions, I should say, the recording will be very short. So bring your questions. You don't have to hold them till that point, but you can certainly ask them via email or discussion forum, and I'll be monitoring that. But I just don't have I won't have the throughput to do a synchronous session until after Thursday of next week. All right. Well, sorry, I took up another 7 minutes. It wasn't a couple of minutes. So I will see you all on Sunday the 25th at 5 p.m. and I'll see you in the in Canvas discussion forum and email and possibly even a Zoom session if you want to set up office hours otherwise. Have a good couple of weeks.